We're jumping straight into SERV Robotics today. Everyone is watching the price action. But the real story is their massive 10x revenue guidance raise and a critical shift toward recurring revenue.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Make sure to subscribe and hit the like button so we can keep simplifying these market moves for you, because there's just a lot to unpack with this one.
There really is. I mean, just to set the immediate stage for you, SERV Robotics recently released their Q4 2025 earnings, and it triggered a massive 16.2% single-day surge in the stock.
Wow, yeah.
Right. And pre-market, it jumped all the way to $10.83. So with the market cap sitting right around $721 million right now, the stock is it's absolutely breaking out.
It is. And, we were going to lay out the whole roadmap for you today. We're going to unpack this explosive, bullish growth story, but also, and this is important, we're going to examine the harsh realities of the bear case.
Yeah, we have to look at both sides.
For sure. And then finally, we'll highlight the specific triggers that you as investors need to watch over the next, say, 30 to 90 days.
Let's start with that bullish side, because to really understand that 16% single-day stock surge, we have to break down the staggering top-line revenue acceleration.
Right. The numbers were just wild.
They really were. So breaking down Q4 2025, revenue hit $0.9 million, which, that's a 400% year-over-year jump.
400%? I mean, that's just massive growth.
Oh, totally. And for the full year of 2025, revenue came in at $2.7 million. That actually beat their own guidance by $200,000.
But it wasn't really the 2025 numbers that got everyone so hyped, right? It was the projection.
Exactly. Management just raised their 2026 revenue guidance to this eye-popping $26 million.
Which is roughly 10x growth.
In 1 year.
Yeah, 10x growth. And the reason the market is actually buying into this, why they're so excited, is the holy grail of logistics.
Yeah.
Recurring revenue.
Ah, right. It's not just one-off delivery fees anymore. Precisely. Their recurring revenue grew over 4x in 2025. It went from like $200,000 in Q1 to over $800,000 by Q4.
So they're proving they can diversify, right? Like moving beyond just charging $5 to deliver a burger.
Exactly. They are tapping into digital branding on the robots, software, data licensing, and crucially, healthcare logistics. All of that is recurring.
Okay, but to pull off a 10x pivot like that, you need a serious financial war chest. Let's talk about their balance sheet moat, because it's pretty unique for a company this size.
It is. They're sitting on $260 million in cash and marketable securities.
$260 million. That's a massive financial shock absorber.
It really is. I mean, they even generated nearly $2 million just in interest income in Q4 alone. Plus, they had a $3.8 million tax benefit from the Value acquisition.
Right. So even with an $80.2 million operating cash outflow in 2025, they still have over 3 years of runway, which makes me wonder, most robotic startups are living paycheck to paycheck, facing constant stock dilution.
Oh, yeah. It's a brutal sector, usually.
Exactly. So how much of a competitive weapon is this 3-year safety margin when they go to negotiate with massive enterprise partners?
Oh, it is the ultimate weapon. If you are a massive restaurant chain, you won't sign a multi-year logistics contract with a startup that might go bankrupt by Christmas.
Right.
That $260 million proves they have the staying power. It de-risks the entire partnership for the enterprise clients.
That makes total sense. So, having established that financial foundation, let's talk about how they are actually executing on the streets. How do they justify that 10x guidance operationally?
Well, the fleet scale is hitting major milestones. In mid-December 2025, they deployed their 2,000th robot.
Wow.
Yeah, and get this, they deployed nearly 1,000 of those in Q4 alone, so the velocity is ramping up. They are now operating across 20 cities with over 4,500 merchant partners.
And their delivery completion rate is phenomenally high, right?
Yes, exactly, 99.8% delivery completion rate. It's essentially flawless execution on complex city sidewalks.
Plus, we are seeing some really strategic expansion, like the new White Castle integration via Uber Eats and DoorDash.
Right. That's a huge proof of concept for QSR's quick service restaurants.
And then there is the Diligent Robotics acquisition, which we definitely need to get into, because that opens up the highly lucrative hospital and healthcare vertical.
Oh, absolutely. And, when you combine that execution with the fact that this was a highly shorted stock.
Oh, right. The short squeeze fuel.
Yeah. That massive earnings beat and the guidance raise likely triggered a severe short squeeze. That added pure technical rocket fuel to the fundamental momentum we're seeing.
But let me play devil's advocate for a second here. If I'm a major restaurant chain, what stops me from just using a cheaper competitor's robot, like someone who undercuts them on price?
It's a fair question, but it goes right back to that 99.8% completion rate.
Right, the ultimate trust metric.
Hmm.
Because in logistics, reliability creates an unbeatable switching cost. You don't want your customers' food stranded in an intersection just to save 50 cents.
Exactly. The brand damage to the restaurant would cost way more than whatever they saved on the delivery fee.
And it's not easy to replicate that reliability. I mean, they had a heavy $15.9 million gap R&D spend in Q4 alone. They are heavily cementing their autonomy algorithms as a really tough-to-replicate moat.
They are outspending the competition to stay the smartest robot on the sidewalk.
Looking at the flip side,
Yeah.
if the growth is so explosive, why are some skeptics pointing to immaterial progress? We really need to look at the harsh realities of the bear case.
Yeah, we do. And it all centers around the profitability chasm. Scaling this is incredibly expensive.
The burn rate is high, right?
Very high.
Yeah.
2025 saw a GAAP net loss of $101.4 million.
Yeah.
And their adjusted EBITDA was negative $78.6 million.
Ouch. Yeah, that's steep.
It gets more concerning when you look ahead. Management projects 2026 operating expenses of $160 to $170 million.
Wait, against that $26 million revenue guidance.
Exactly. So even if they hit that amazing 10x growth, you're still looking at an operating margin somewhere around negative 85%.
Man, I mean, I kind of compare this business model to building a nationwide cell phone network, you know?
How so?
Well, you have to pay to lay all the expensive towers, secure the spectrum, all of that. Before you collect a dime of subscription revenue, you're building massive physical infrastructure.
That's a really good analogy. But the per robot math is where the bears really dig in.
Right. Break down the specific math problem for us.
Okay, so in 2025, they made $2.7 million across roughly 2,000 robots. That implies only about $4,350 in annual revenue per robot.
Which is pretty low for a piece of advanced hardware.
It is. Now, to hit their 2026 guidance of $26 million, assuming an expanded fleet of, say, 3,500 plus robots, they need to generate roughly $7,400 per robot.
Whoa. That is a massive 5.5x efficiency improvement required in just 12 months.
Exactly. It's a huge leap.
And we hear management promising disciplined capital expenditures of around $25 million for 2026. But can they realistically flip a switch and squeeze 5.5 times more money out of each robot in a single year without alienating their merchant partners?
That is the multi-million-dollar question. And the short answer is not through food delivery alone.
Right. The margins just aren't there for food.
Exactly. That is why the recurring revenue streams, the advertising, the data licensing, and especially the healthcare vertical are not just nice to have, they are mathematically essential.
So now that we understand this tug of war between the massive 10x revenue growth and the severe cash burn, let's outline the exact events that will determine the stock's next move. What are the immediate triggers for the next 30 to 90 days?
The biggest one is Q1 2026 earnings, which will hit in late April or early May. This is the ultimate show-me moment for that $26 million guidance.
Oh, for sure. The market gave them the benefit of the doubt, but now they want proof.
Right. Investors will relentlessly scrutinize the fleet deployment velocity. Are they hitting the target numbers? And is that recurring revenue actually growing?
And then there's the Diligent Robotics validation, right? Investors need to see if that healthcare recurring revenue actually hits the $1 million run rate.
Exactly. If it hits that run rate, it proves the multi-vertical strategy works in real life, not just on a spreadsheet.
And I imagine everyone will be watching for new partnerships too.
Oh, absolutely. The market wants to see more major QSR chains following that White Castle template. The more enterprise buy-in, the better.
Beyond the company itself, there are also some pretty strong macro tailwinds to watch, right?
Yeah, a big one is ongoing labor cost inflation. As human labor gets more expensive, autonomous logistics become highly attractive to these big enterprises. The ROI just makes sense.
Right, the robots don't ask for a raise.
Exactly. Plus, there are whispers of deeper institutional validation. You hear sentiment out there like, NVIDIA loves it. And even just rumors like that can trigger sector rotation flows, pushing more institutional money into the stock.
Okay, but with analysts reportedly seeing 67% more upside, expectations are just sky high right now.
They are priced for perfection.
So if Q1 fleet deployments fall short of that 3,000 robot target, how violently could this highly shorted stock swing the other way?
very violently. When a stock is heavily shorted and priced for 10x growth, any slight miss is going to be punished. The short sellers will double down and momentum buyers will bail. The $260 million cash pile prevents bankruptcy, but the stock price could certainly crater if they don't execute perfectly.
So it's incredibly asymmetric.
Totally. To summarize the risk and reward here, SERV Robotics is a high-conviction, pre-profitability growth story. They are executing flawlessly right now on a 10x trajectory.
Yeah.
And they are backed by a bulletproof balance sheet. But it is entirely dependent on proving their per-robot unit economics in these coming quarters.
Here's your lowdown to take away. Beyond the stock price and the squeeze mechanics, consider how the blending of food delivery scale with high-margin hospital logistics could fundamentally rewrite urban infrastructure.
It really is a paradigm shift.
Right. If SERV Robotics successfully transitions from growth at all costs to profitable growth in the next 12 to 24 months, we aren't just looking at a successful company. We are looking at the blueprint for the automated city of the future. Thank you so much for tuning in. Stay curious, keep watching the tape, and we'll catch you next time on the Easy Money Show.